Good morning, ladies and gentlemen. Well, in a week that saw net very little action, very little price change, the risk dial kept on improving throughout, and we're now somewhere around this 40 area, indicating to me that things are actually getting better under the surface rather than worse in terms of risk. And then we are probably in a mild risk on phase. I will now examine what those reasons are and what I am looking at and why I just cannot get negative on the markets in general, because I think we have transitioned, as I said last week, from a trending market into a highly technical market where ranges and respecting the ranges is going to be very important. As always, let's start our review with the bond market. And I think that basically we caught it, or we explained it just right. We had the squeeze midweek after the BOJ did nothing. And then what we did is we gave it nearly all up. The reason simply being is that without further data about the economy and without seeing exactly what the Fed wants to do, although we all know they're going to do 25, it's very difficult for this market to move much more than a few basis points up or down. The trend still is slightly positive. I mean, I think the odds of us breaking these levels here around 433 and twos are very, very slight. But can we revisit them? Absolutely. It's a technical market. If we move on to the fives, much the same thing. I mean, we closed exactly where we opened the week. This kind of area could probably trade, but it will probably give us a good entry point for maybe some longs around the 370 area, and the 30s much the same. As you can see, the 30s closed the week nearly exactly to the tick where they opened it. To me, this is a typical technical market that is going to try both ends and is going to try to suck you in the wrong way at the range extremes. And the range extremes to me in 30s are now 345 to 377. Depending on minor data, we will get to either of those, but I don't think they break unless we see some important data. And the only thing we have next week is PCE. That's important and forward looking. I think that is going to be on Friday next. When that comes out, it will be the only time that we can have a meaningful move in the markets. Even the yield curve is doing bugger all, to basically put it in plain English. Is it likely, these are the 2s, 10s, is it likely to go much higher? I mean, it's likely to just test the top and then test the bottom. I'm not going to bore you, but basically the 2s are stuck because of the Fed. The 30s are stuck because I don't think the yield curve is going to be basically pinned around them, and they're going to be the ones moving least. And everything else, the belly of the curve is just going up and down for technical reasons, i.e. buyers, sellers, issuance, and so on. Now, these are the 530s that keep on bleeding. What that tells me is that the yield curve is normalizing. And let me put that more precisely. It's normalizing in the 5s to 30s area. And the only way to put it is that the market is looking through this inflation period and through the Fed being tight. And at some stage, it's saying the tightness that the Fed is causing at the moment will cause inflation to go down, and the yield curve will normalize. And then that is when the twos will start moving and the whole yield curve will normalize. But because of the period of time that it's going to take, the twos can't really move yet, and therefore the only thing that can move is the fives, 30s. But I think that even that is going to be very, very technical in its movements, and it's going to be only a few basis points here or there. It is what it is. We can't force trades, and until and unless we see a major opportunity, we should not trade. That is what I can, that is what my years of experience tell me, that this is not a period to start forcing trades at supports. It's the only trades that I would like to do are at resistance levels when everybody else is getting, worried about something. It really is not the time to overtrade. I just want to attempt to deepen what I've just said about the yield curve. The market wants to normalize this part of the curve. As you can see, there was very little difference in the week's action in the settlements. The market is preferring this 5-year area at the moment simply because it's trying to normalize this part of the curve. What is it in essence saying? We don't know how long it's going to take for the Fed to beat inflation. We know that this part of the curve can't really move very much at the moment because it's going to get attracted towards the terminal rate. But if the terminal rate is, let's call it 5%, we know that that is going to be enough to beat inflation, and therefore we don't know whether it's going to be in 2 years' time, in 3 years' time, in 4 years' time, but we know that at some stage that is going to be enough to beat inflation, and then this curve will be at worst flat and at best little bit positive. Why is that? Well, if you look at all the other indicators, the indicators of expectations of inflation, they're all very, very stable. 5-year doing absolutely nothing at lower levels. 10-year break-even rate of inflation basically as low as we have seen it since quarter 3 of or quarter 2 of 2021. Term premium very stable at the lows. Fitted instantaneous forward rate in 2 years hence, 360. So if you look at that 360 in 2 years and where the 30 years are, and we can go back to this chart, where are we? We are at 377. So basically what they're trying to do is trying to normalize the curve further out, saying that yes, this will work, these higher levels here will work, and then the yield curve goes back eventually to a normalized structure of flat to slightly positive. And since they don't know exactly when that is going to be, this is where they're preferring to invest. Much the same thing as in the US is happening in Germany. My view, Schatz is going to trade no higher in terms of futures than this level, which is around the 1020 area, 106, 1020, and then, this 68 resistance, which I don't think is going to be broken before the ECB comes in a couple of weeks' time. So I think it's going to be a quiet period for everything, including the tens. We are definitely in a mild move back down, but I think that over the course of next week, we're going to be trading somewhere around the 220 area, between 2 and 220, and we won't move very far away from there. So basically, what is that saying? If I can't see Germany going very far and I can't see the US going very far in terms of the crosses, you can see that this kind of level is very, very appropriate to me. You can see that every time it tries to go up towards this 152, it gets smacked back. So really, you have your range. 152, 125 is your range for the differentials, and that actually gives you more or less your range for the tens and the bunds. So it's not a market that you want to force. It's a market that you want to try and trade at the extremes of. Just like bonds, the dollar had a relatively boring week. What's interesting is that it can't get above 102.82. And I think it's going to be very, very difficult to see it much below this 100.39 area. I think if you are short, you should definitely cover there because the risk reward is very bad at that level. And then you're looking for a reaction higher if you're bearish to sell, probably back towards the 102.82 if not higher. But I don't think anything is going to happen next week. I don't see any reasons why it should. The bond market is not giving any indications that it wants to move the differentials in any particular directions at the moment. It's a 20-30 basis point range differential between the EU and the US. So I think stability is probably more stability is more likely than anything else. But certainly risk reward at 100.39, bad. What does that translate into as a level in Euro USD? You know, just above 110 or just below 110, depends on what charts you look, whether it's a weekly or the daily. But I would have thought if you see this 109.90 area, you know, the high 109s, you definitely think there that the risk reward is not good and that you really don't want to have a position at all, certainly not long euros at that level. Gold is actually performing very well. I still am of the opinion that if you see this 1959 level, it is a much better short than long, and that the risk reward is all to the downside. I really don't see why the market would want to be strong further up than that. But, you know, I've been surprised by the strength of it in the last 2 or 3 weeks, but I think a lot of that is a January effect. Certainly I know that I am getting rid of all my gold up here at 1959, because if you look, it's every single indicator is vastly overbought. And, you know, unless you are leverage short and it keeps on going up, I think you can see from this chart that the odds are that even if the market starts continuing higher or not coming back off 1959, you will see opportunities to get back in at least at that level again. So unless there is some amazing news, you know, what could it be? Who knows? I think technically, and I think we have transitioned into a technical market for everything, 1959 is definitely the level you want to be out of gold at. I want to draw your attention to DBA, which is concentrates on agricultural commodities. So it's the agricultural equivalent of DBC. It's not a great ETF because it's constantly losing money because it invests in futures in the agricultural sector. So and that tends to be that tends to have a negative yield curve. That tends to have a negative yield curve, i.e., forward prices are higher than spot prices, and therefore, if you buy the forward, the longer dated, you ride the yield curve down, and therefore you tend to lose money. So I'm not recommending this ETF in the slightest, but what I'm saying is that it gives you an indication of where the prices of agricultural commodities more or less are going. And I keep on reading how wheat is going to be in a huge bull market, and fertilizer is going to be in a huge bull market, and everything is going to be in a huge bull market, and there's going to be a lot of inflation. Well, this is not what this chart is saying. Could it be a very important weekly support? Yes, it could be, and it could be ready to trend higher. But I just want you to be aware that basically we were at 23 and now we're at 19. So this is a good 10% lower than it was mid-year last year, and basically at the same level as it was at the beginning of 2022. So we haven't seen, or this chart is saying that we haven't seen a whole load of food inflation, and B, we're unlikely to see a whole load of food inflation. Certainly, I think that if it comes down, and I will keep my eye out on it, to this 1779 area with this turned 200-day moving average, weekly moving average, it's going to be a very, very interesting long play. But that is, that's almost 10% away. So all I'm trying to do is keep your attention to the bigger picture, that there isn't a huge amount of inflation going on in the agricultural sector, because if there were, the yield curve there would change, and therefore these would be there would be less bleed in DBA. That's all I'm saying. I'm just using it as a as a confirmation tool to my other macro views. DBC itself is doing very, very little. But what is significant is that it's not breaking down, and that this area around 23, every time it gets anywhere near it, there are plenty of buyers. And also, DBC against gold keeps on turning these moving averages, saying that even if it goes down a little bit, gold is the preferred investment until this area here, which to me indicates two things. One is that there isn't all that much upside in oil at the moment, and this is the oil. This 75.16 on the monthly chart seems to be an area of very good support. So every time it drops to 75 and lower, there are buyers. But if you look at it at a daily chart, I mean, all it's doing is basically correcting the oversold levels, yeah. But the 200-day moving average is still pointing down, meaning that even if we were to get to these kind of levels, very close to 90, it's still in a bear phase. Now, could it go sideways to a little bit higher for weeks, for days and days and days, many days, say a month or two, and then change the trend? Yes. But I don't think that this chart is saying that there is any immediate danger of this going much higher than 90. This kind of level, this kind of level seems appropriate, 85. So that is another thing that tells you that there's more nervous stability in the bonds than anything else. And really, the extremes of the lower ranges in bonds are unlikely to be broken. You are unlikely to get a trend down in yields simply because we don't have the appropriate inflationary setup to do that. Inflation isn't going to collapse, but inflation also is not going to run away. Let's have a look at what is happening under the hood of the equity market. Now, these are my risk indicators. Yeah, some of them, XLP, XLY, tends to be a very good one over time. And basically, XLP, XLY has been in a bear phase now for at least 2 or 3 weeks. That tells you that there is rotation going on from defensives into more aggressives. I've been telling you for a while that XLY is the one that bears looking at because, I've never seen a recession in which the US consumer didn't get slammed. One can argue that XLY is not what it used to be because Amazon's such a big part of it, or Tesla is such a big part of it, or this or that. But over time, these things tend to negate each other or basically average out. I've never seen a market that drops SPX violently in a period when XLP, XLY is going down. Also, you know, this is SPY PSCD, which is that the small cap retailers. Well, you would have thought in a recession, or something that indicating recession, the small cap retailers would absolutely get killed. And they are rallying against SPY. If you saw what happened last week, the Dow was by far the weakest component, and that's index rather, and that is by far the most defensive of the indices. If you look at the government spreads, ITOT over government, I mean, how is that bearish? I mean, it just goes up and down, and settles nowhere. SPY over TLT, same thing, up, down, within what are very tight ranges and being compressed, which tells you that a big move will come, but it's unlikely to come in the next week or so. So that is indicating from all the risk spreads that you're having nervous stability. Even the ones that are most volatile, like the SOX against the yen, I mean, they're just going up and down sideways. So there isn't a single risk component that's telling me that we are towards the lows of the range even, let alone that we should collapse in that risk indicator. And if the risk indicators aren't collapsing, the odds of something like SPX collapsing are very, very low. So basically what you want to do is buy it on support when everybody else is getting panicked, and sell it at resistance when everybody else is being bullsed up. That's all I can say, and that is why I just can't sell equities when they go down. I see no reason to do it. So what is SPX doing? Well, not a lot, right? People always get bearsed up at the worst possible level. That's what the markets are designed to give you in terms of, psychology. This area is just not getting challenged, and we basically need closes way below 3,800 to get into a bearish state of mind. While this is going on, this is just sideways, and you can see the Bollinger Bands compressing. So this is a market that is just going to go sideways until the Fed, and that's a 195-minute chart, so two bars. If we look at it on a daily basis, and let's enlarge this, I mean, all it did last week is come back to the moving averages and test them and reject. But the upside move that it can have to these upper Bollinger Bands, and you can see it always comes back, and nobody's going to tell me that we're going to be through the Bollinger Bands for the Fed. That is very unlikely. If you play those odds, you deserve to lose. We're going to be very much unchanged. We're going to have 5 days, what is it, probably 7 trading days, right, of testing these upper levels around 40.30, 40.40, and then coming back to these levels around 39.50, and probably going into Fed very much in this kind of area where we've been trading for a couple of weeks. 2 weeks ago, I said that EEM closed above 39.93 and that it was likely to head towards at least 42.25. I still believe that. I'm a seller of what I bought at 42.25, simply because I think we are at the top of these Bollinger Bands. But this is another argument why it's unlikely that the US market is going to collapse, because if EEM is strong and if Europe is strong and in certain other individual markets or components of what is effectively SPX are strong, SPX itself is very, very unlikely to move to extremes. And therefore, I just can't sell equities. I can take profit in equities on stuff that I buy lower down, but I cannot sell support, or I can't even sell it through support. I'm a better dip buyer at levels of everything, and taking profits at levels which are probably unwarranted. And next week, I think that when you get to 42.25 in EEM, that is going to be an indicator that the US market probably isn't going to move much more to the upside. Even Nikkei, which was the one that was most scared of the BOJ and, had the bit of a tantrum back up towards the moving averages, it's not going to go very far from here. It's going to trade around this 27,000 area. But it just shows you if there is no impulsion in all the other markets to the downside, why would you expect any violent down move in SPX? Terribly unlikely, and especially since the largest component, or one of the most important ones, which is the big cap tech stocks, which are most prominent in NASDAQ, are doing absolutely nothing. Let's enlarge this, and you will see how support, and every support that I tell you is important, seems to hold. We're still in a bearish phase of the market. I mean, all the moving averages are pointing down, but all the supports hold, and then you go back and trade the resistance. This tells me, yes, you sell resistance. You sell it when everybody is bullsed up at this kind of 11,850 area, but you are basically looking to buy the dip and buy it on support. This is not a market that is going to trend for a while. And it's funny to see history repeat itself. We have another gap in the VIX down to 1840-ish, whatever the hell that is. It'll get filled. It'll get filled when the market feels, the FOMO, and you have to go and buy stocks. Oh my God, it's not going down. The usual rubbish. it's going nowhere. What this chart is telling me is that this is a technical market which is trading from level to level without much impulsion. As I showed you earlier, none of the risk indicators are in a particularly bad phase. In fact, some of them are in a very good phase. Uh, this is not the kind of market in which you short stocks. It just isn't. It's a market where you look for extremes, you buy the dip, you wait for everyone to have to cover, and then you sell the extreme and you get out. It's you take what the market gives you. The market is giving you very plain indicators that it's not in a bear phase. It's giving you very good levels to trade against, and it's also telling you where to get out when EEM gets overbought, when Nikkei gets overbought, when Europe gets overbought. That is likely to be the level where the US can't go much further. So let's keep it short and sweet. I've changed some of these levels, not many, and that's it. Once those levels are reached, you want to be out. I think it's as simple as that. This is a consolidating market which is awaiting data to have its next big trend and the reason for it. It's not a market to push any extreme. Once one of those resistance or support levels are reached, you're basically out or in at them. As simple as that. Have a wonderful weekend and tweet you tomorrow.